Hey, I'd like to welcome you to another episode of the Mission Matters Money Podcast, your source for all things money. My name is Adam Torres. You can follow me on Instagram at AskAdamTorres. Keep up with my book releases, book tour schedule, signings, all that other good stuff. Always love to connect with you there. And as always, if you'd like to apply to become a co-author of one of my upcoming books, just head on over to the website, missionmatters.com, and click on Become an Author to apply. All right, so today I have Shelley Giordano on the line, and she's co-founder over at Academy of Home Equity and Financial Planning at the University of Illinois. Shelley, welcome to the show.
Thank you, Adam. Pleasure to be here.
So excited to get into today's topic. So we're going to talk about home equity as a buffer asset and retirement income. But before we do that, let's talk a little bit more about the Academy. Tell us a little bit more about what you're up to, please.
Yeah, great. Yeah, so our mission is to help American retirees understand the value of their number one asset, which is their home. About 2/3 of the net worth of the average American is tied up in his home. And yet Americans don't generally think of their home as a vehicle to help them weather the volatility out there in the retirement market, so to speak. So for the last about 8 years, we've had a group of academicians and practitioners, mathematicians, actuaries, gerontology, financial gerontologists, a whole group of people who are interested in helping make sure that Americans can retire securely, looking at the role of housing wealth and how that asset can be put in play to help people weather the volatility out there in the markets, which has been sort of a theoretical question up until now. It's just been the math, but people are really feeling it right now since we've moved from being in an 11-year bull market to just this precipitous drop. So people are opening up their retirement investment portfolios and recognizing that they're not holding the same value that they did before. And people just generally understand that you don't want to have to sell at a loss. You know, you want to buy low and sell high. And so that's been the case for the last few years, but we've now just finally seen the pain that happens when you have to start selling your invested funds at a lower rate. So yeah, go ahead.
You mentioned something that a lot of Americans don't really know about these assets. I mean, I know this is going to vary obviously from person to person, situation to situation, right? But what do you think are some? And you've done a lot of work and it's been in the space for a long time. What do you think are some of those reasons for that?
Well, I think it's more of a behavioral finance issue. I mean, we've looked at it and looked at it and looked at it, and not even considering doing a reverse mortgage to help free up some of that equity without having to make a mandatory monthly payment seems, like something that most people would be interested in at least knowing something about. But people are very emotional about their homes, and we just are. And so I think for a lot of people, you think about your house, actually you are thinking of it as an asset, but just sort of as if everything else goes kerflooey, I still have my house. Instead of thinking of it proactively to deploy your home as an asset to protect all your other assets, so you don't have to be drawing on undervalued invested funds. You can substitute using draws from your home via a reverse mortgage, and sort of protect and conserve the whole picture, rather than going through your portfolio, taking all your distributions that you need to support your spending without regard to the value of the portfolio, and then as a last resort going, oh gosh, the only thing I've got left now is my house. So then you either have to move, or then you try to take out a reverse mortgage at that point, and you have to. There's so much spending that needs to be supported through the reverse mortgage that it's just not viable for supporting a 30-year retirement. So I and honestly, Ed, I mean, reverse mortgages have had a bad bad reputation over the years, which is really unfortunate because HUD FHA, which regulates the home equity conversion mortgage, which represents about 95% of reverse mortgages out there, they've really worked hard to make sure that reverse mortgages are only provided to people for whom it will be a sustainable solution, and really worked hard to negate the kind of abuses in the past. So people who think that they know how reverse mortgages work are probably thinking about the way that they may have worked, 15 years ago. So, so that's
let's get a little bit more into the academy. So tell me a little bit more about that, please.
Yes, well, it is being directed by Dr. Craig Lemoyne, who runs the financial planning program there at the University of Illinois, and we have about 13 members. Our original ones were Barry Sachs, who is both a PhD in physics from MIT and has a law degree in tax law from Harvard. And so he was the person who came with the original math behind the idea of, how can I avoid having to draw on my portfolio? Is there an alternative asset? Is there an asset that is not correlated to what my investment portfolio is doing that I can temporarily use when the market, you looking forward to a retirement of 30 years or so, there are going to be dips in the market. And how can I protect my portfolio and not have to sell out of a losing portfolio? So he was the first person who took a look at that. And since then, he has attracted people like Dr. Wade Pfau, who's a professor of retirement income at the American College of Financial Services and a PhD in economics from Princeton, and Dr. Jamie Hopkins, who is the director of retirement research at the Carson Group. There's 13 of us, so but these are the folks who are the four that I mentioned, who are sort of leading the charge, doing the research, and beating the drum for financial advisors to be thinking about the house as an asset for their clients. I mean, one of the things that's really frustrating to us is that folks go for financial advice and, are paying money for advice, and yet compliance departments for many financial advisors don't allow them to discuss the house at all, despite all of this research to demonstrate that it's in the client's best interest to at least take a look at what the portfolio could do if over time distributions were not taken in bear markets.
Yeah, no, I totally get it, and I remember that was pretty. It's kind of interesting who makes that decision and how it's made, and it seems like it just stays status quo, right? Like the compliance department's like, I don't know if we should do this, and is everybody else doing it? It's one of those kind of like, if everybody else is doing it, it's acceptable, but nobody wants to be the one, right?
Well, luckily we've had 5 the broker dealers who have dropped their prohibitions. But it's kind
wonderful.
of a structural problem. Yeah, it is. But it's a structural problem because the advisor can't get paid for a referral from a mortgage company. It's just not allowed.
Yeah. Yeah.
And so there's no direct revenue coming in the door. So you can understand why somebody in the compliance department would say, why should I take on any more responsibility or risk that these advisors are doing the right thing when there's no line item, there to justify my letting them do this. So that's just, really unfortunate, but I do agree with you. It's just kind of the status quo wins.
So what do you
definitely.
think? Yeah, no, it just is. So that being said, Shelley, so if somebody's listening to this and if they want to learn more about the Academy or what you're up to, I mean, what's the best way for them to connect?
Well, I would say the first thing to do is go to the website, the Academy of Home Equity and Financial Planning, University of Illinois, and there's just there's a bibliography of articles and websites and research papers and books and podcasts even that we'll have to put this one on there. So that's a good place to start because that's going to be a sort of dispassionate, unbiased approach to reading about the research that's out there. The National Reverse Mortgage Lenders Association has a very good website as well. And then, if you get to the point where you'd like to talk to lenders, the National Reverse Mortgage Lenders Association can direct you to lenders. But I would just say to people who are on the line that, don't be satisfied with just sticking with one lender unless somebody has, like your financial advisor may have recommended somebody that they know is trustworthy. I mean, just the luck of the draw, when you get on the phone and you really like somebody who is selling a reverse mortgage, go through the discipline of getting a couple of different quotes, probably 3 quotes, just to make sure that you're getting the best deal for yourself that you can. It's not different than getting a regular mortgage. You can negotiate the terms, and so people are uncomfortable doing that, but you won't really know if you're getting the best quote that you can get until you say to another lender, oh, I have a quote from lender A, tell me what your best quote is. And so that would be my recommendation to everybody, that 2 or 3 quotes is always a good idea.
Fantastic. Well, hey, Shelley, really appreciate you coming on the show today and sharing more about your background and all the great things you're doing over at the Academy. And to the audience, as always, thank you for tuning in. Hope you got a lot of value out of this. If you did, don't forget to subscribe to the podcast, leave me a review on the Apple iTunes Store. If you're watching this on our YouTube channel, Mission Matters Money, definitely give us a subscribe there, but also leave us some comments in the video. I'd love to hear what you're working on and what kind of projects you're up to. And Shelley, thanks again for coming on the show.